Hi, I'm Scott Sterrett with Sterrett Wealth Management, a part of Canaccord Genuity Wealth Management. So today we're very fortunate all the way from sunny Toronto to have Adam Mitchell. Adam is the lead portfolio manager with the NewGen Credit Strategies Fund. So it's a manager and a fund that we just added to models here relatively recently. NewGen's been around for quite some time, but Adam's relatively new to NewGen. Adam's been there about a couple of years now, just over a couple of years. Prior to that, he was working for Polar Capital, which is a very large Canadian hedge fund on their fixed income bond side of things. And prior to that, he worked at the bank trading desk. That's where he got his start. With three boys, I'm surprised, Adam, that you have enough time to work, let alone take time away to chat with us today. But thank you
Well,
very much.
working is the easy part of my life.
Are they into hockey and things like that at this time of year?
Yes, yes.
Yeah, yeah. So definitely a full-time job in itself. So let's start at the beginning. So why did you start a credit fund at NewGen?
Yeah, first of all, so when I worked at a hedge fund in Polar, I worked as part of a multi-strat, which you're helping manage a sliver of capital within a broader fund. NewGen offered me the opportunity to have my own standalone fund, which was a good opportunity for me. We really looked at the alternative landscape in Canada, and we looked at what credit strategies were out there, and the landscape of products that were offered were generally either levered investment grade credit products or private credit. And we saw a niche area within the Canadian landscape to offer to end advisors, primarily. Most of our clients are financial advisors, a way to get access to the mainly high yield market, North American high yield market, in a smart, differentiated fashion. And we'll get into the strategy later, but really it's to help advisors and their clients gain exposure to North American corporate credit as an asset class, which traditionally has been difficult for advisors to do on their own, i.e. buying and selling bonds, convertibles, and preferreds on their own. There's a lot of impediments for advisors doing that directly, and we hope to serve the need by providing our services to a kind of a small slice of their portfolio. And as part of a broader portfolio, this strategy is a bit unique and hopefully uncorrelated to many things within the average advisor's portfolio.
Oh, great. Yeah. So, I mean, having, approaching kind of 20 years now in the industry, one of the things that, I think you've probably seen is size matters. And,
Yes.
you're taking from a different approach. And I think this is part of NewGen's approach too, but you're not looking to necessarily compete with the big banks for size and get billions and billions of dollars in that. Right now the fund, like I said, even though you've been around 20 years, it's relatively small in the big scheme of things.
Yes.
It's still a big fund, but it's relatively small. But you've also said that you aren't going to let it get big. You're gonna cap it at some point way down the road, hopefully, but cap it
Right.
at some point because you don't want it to be too big. Can you talk about how you have a competitive advantage with size over some of these big money managers on the bond side, and why it's actually very beneficial to keep the size of the fund small?
Right. Yeah. So what's happened over the last, 10, 20 years is there's been an enormous consolidation of asset managers, right? And enormous increase in passive investing. So what that means is investment management firms and the subsequent funds are getting larger and larger and larger, but they haven't necessarily, added the investment resources or investment skill at the same pace as growing assets. And so what ends up happening is you've got a lot of very large managers that in many and sometimes are stretched, in terms of managing their portfolios. So there's funds out there that are $10 billion, right? Our fund is hovering close to 100 million. And so what that does to the market in our space, in the credit space, is it provides a lot of opportunities in what I would call orphan or off the run or smaller mid-market tranches of debt. And the math is pretty simple. If you're managing, 2, 3, 4, 5 billion of credit capital, you tend to need position sizes of 50 to 100 million, and often even larger than that. And so if you're a large manager, you're not really focused on the 150, 200 million, $300 million tranches, because quite simply, you just can't get a position on in your portfolio that at the end of the day makes a difference. And therefore you don't devote the resources to that sector of the market. They're devoting their resources to big capital structures like a Charter Communication where there's 50 billion of debt. We are focused on off the run, smaller mid-market companies, public companies, but ones who may have one tranche outstanding or in a unique industry, or it's a busted convert that doesn't in an index. And so, that area of the market, I think, offers a lot of inefficiencies to exploit. And for us, given our size, we don't need the liquidity. We don't need to buy 50 million of something to make a difference. We need to buy 1, 2, 5 million of a bond, which there's plenty of liquidity to do that and where we operate. And what ends up happening is that corner of the market is mispriced relative to the true credit risk, whether it be 100 basis points or up to 200 basis points. And it's mispriced just because there's less people looking at the bond. There's the bond may not be contained in any ETFs, so you don't get the passive money flows. And so there's just less competition for ideas in the areas that operate. And as a result, we're able to construct a portfolio that has similar, if not better, credit risk than a larger portfolio, more index type portfolio. So less risk, but higher return.
Yeah, great. Yeah, so I mean, when you say, okay, so you're looking at, for lack of a better term, sometimes orphan positions, smaller bond deals that the big guys, so to speak, don't want to or can't get involved in. I mean, that must take a lot of work and due diligence and poring over, legal papers to see where your risks are and things like that. Is that what you spend most of your time doing? Is the really boring stuff? I mean, you see on TV bond trader and they're yelling things back and forth in a big bank or whatever. But is it really just a lot of just dig deep and really work and look at the legal covenants and things like that are part of the particular issue?
Yeah, I would say really everything starts with us with free cash flow. And so we tend to focus on more mature businesses, that, maybe not as growing as rapidly, businesses like restaurants or building products or industrials, businesses where we can actually see the free cash flow. So the starting point for us typically on credit analysis is, does the company generate free cash flow? And you would think that that's a simple calculation, right? But in fact, it's not. It's not done very well by many market participants. It often takes a lot of time to really figure out the free cash flow of a business. And so that's really the starting point for us is really trying to figure out the free cash flow generating capacity of the business, and then comparing it relative to the debt load. And that's kind of the first entry point that we go through. But yeah, it's really, we're trying to figure out in corporate credit is, are we going to get paid back? It's a very different analysis than an equity investor, where you're looking at what's the growth, what's the potential market share gains, what's the total addressable market, and you're forecasting far in the future. It's very different in high yield credit. We're often in companies where equity investors look at and say, well, that's an uninteresting company. You know, it generates free cash flow, but it's not growing. You know, for this and this reason. And so we like those areas of business. And as a credit investor, you have very different, you know, objectives than an equity investor. We're just trying to get paid back. So, you know, the typical analysis, we model free cash flow. We listen to all the company conference calls. We meet management. We read the bond indentures. Fairly traditional, you know, traditional stuff. You know, so that's kind of how we approach it, at least in our core corporate carry portfolio. In our event-driven side, which we may get into as part of this, is very different, and we're focused there really on handicapping, you know, corporate events that occur that would make the price of a bond go up and down, which is a little bit different than your traditional, you know, credit analysis.
Yeah, so let's talk about that. I mean, I would say you kind of divide things into various buckets. You know, one you touch base on, which is your corporate carry, which is just the traditional buy and hold, so to speak, bonds that you've done a lot of work on and are very comfortable
Yes.
with the cash flow. And then you alluded to your event driven, which, as it sounds, it's, you know, a company or a structure that's undergoing an event of some sort.
Yes.
How else do you look at kind of the portfolio and dividing things up into the various buckets?
Yeah, so our portfolio, the way we do portfolio construction, first of all, we don't use leverage, which I think is a very important point. We don't think we need to use leverage. And so that's the starting point. So, you know, we have $100 of assets. We typically have 25 to 50% of the portfolio deployed in what we call our core corporate carry strategy. And that's really a small portfolio of, you know, 10 to 20 bonds that the return is going to come from generally interest income or eligible dividend income. And we intend to buy and hold those, but we will, you know, trade the portfolio, bring new names in, sell names out. But the idea is that we're capturing a credit spread above the risk-free rate that is well above our expectations of default. The intention is to have no defaults, and, you know, clip a stream of income kind of between 7 and 9% in that portfolio. And as credit spreads tighten, we will bring that part of the portfolio down to, say, 25% of the NAV. If credit spreads widen, we'll bring it back up to 50%. The second kind of sub-strategy is our event-driven strategy, which I would argue is the exact opposite of the core corporate carry strategy. Here, we're not necessarily focused as much on the company fundamentals, the traditional credit analysis. We're really focused on trying to figure out the probability of a corporate event occurring, and what that does to the end bond price and when it happens. Kind of three variables: probability of the event occurring, what happens to the bond price if the event does occur, and then when does it occur. So a very simple event, as an example, is a refinancing. So if we think a company is going to refinance a bond early at par and the bond is trading at 99, you know, we may buy the bond at 99 under the assumption that the company refinances in 2 months, and we'll get par plus our accrued. And, you know, what's the probability of that happening? When does it happen? And what's the outcome? Blend all that in to calculate the IRR. And if it makes sense, we'll take a position. Other events that are common are things like M&A. So when a high yield bond company gets taken over, typically it's by a better quality credit company. And so you may have an improvement in credit, or you may have the requirement under the bond indentures that the bonds have to come out. That is an event. Credit upgrades and downgrades are events that change the prices of the bond. So really there's all sorts of different events that on a daily basis can really move the price of a bond. And the event-driven strategy is like a treadmill. We try to, you know, find these events on a daily basis, invest in them. They roll off quickly, typically 30 to 180 days, and we got to find the next event. And there's natural liquidity in that strategy. And we're trying to, you know, have a high hit ratio of 85% or above. and IRRs in the high single digits. And the reason why there's of excess return in the event sleeve is because typically long only corporate bond managers don't typically fixate on events. They're more focused on the long-term fundamentals. So when an event occurs, the bond goes up in value or down, they may be buying and selling, not based on their view of the event. And so that's where we think, we can create an edge, and given our size, there's certain events where there may not be enough liquidity for people, but there's plenty of liquidity for us. And so, that's formed about 2/3 of the return of the fund, and mainly from capital gains. So those two things in balance, form like the majority of the strategy of the portfolio.
Now, you also, I think, try to protect the portfolio.
Yes.
And, that could mean, putting in place insurance through the option or futures market.
Yeah.
It could be having a whole bunch of cash, available if you're kind of, lack of a better word, spooked by what's going on in the overall market. How active does the fund tend to be around the edges with those types of buckets?
Yeah, so we have what we call a risk overlay bucket, which is intended to, when we think it's appropriate, manage the market risk of the portfolio. And when I mean market risk, it's the daily, monthly fluctuations in prices due to the market, not necessarily the idiosyncratic risk associated with the position. So the way I think about it is research is the best risk management strategy, right? The portfolio is a collection of very idiosyncratic things, ideas, and research is the best way to reduce risk for idiosyncratic ideas. Secondly, the market can move up and down for a variety of reasons and affect the value of the portfolio. We want to try to take out as much market risk as we can, or reduce the market risk. And what we don't want to do is be constantly buying and selling our positions and incurring bid ask as we change our views on the credit market. So the risk overlay offers us a strategy to very quickly reduce the market risk of the portfolio, or increase the market risk as we see fit. And what we've done typically is done that through the options market, often with HYG, which is the ETF, high yield ETF, using put options. But there's a variety of other ways to try and hedge, using VIX calls and other things. And the whole point is to just dampen the volatility of the portfolio, the market risk. And we can do it very quickly given our size, in these liquid indices.
Right. Now, my wife on a constant basis tells me I'm wrong a lot. I really don't think I'm wrong at all. But I'm joking, of course. Well, we all know that, we're going to make mistakes. How do you avoid a mistake being an issue for the portfolio? Because, like you say, you spend so much time on the research trying to deliver a reasonable return to people, and and on top of that, you put a risk overlay on to make sure that there isn't these wild volatility swings. Hopefully, if the market goes too much up or too much down, but how do you limit that or try to limit those big errors from happening and affecting client returns?
Yeah, a couple things. So from the very start, we typically keep our duration of the portfolio very low.
So that's the maturity, the length of time to a bond maturing, essentially.
Exactly. So we try to keep our duration under 2, and oftentimes it's closer to 1. And as a result of that, we don't take interest rate risk, or we try not to. And interest rate risk is a big part of the volatility of corporate bond portfolios, right? We often think about credit, the risk of default, but the reality is interest rate risk is a big portion of the risk of corporate bonds. So we try to limit that. We are not experts at interest rates. We don't trade interest rates. So we keep the duration of the portfolio short, we try to take pure credit risk, not interest rate risk. That's the first part. So we will not have the same return profile as a long only corporate bond fund that may own 30-year investment grade bonds, 10-year investment grade bonds, et cetera, et cetera. So we don't benefit big when interest rates come down, and we don't lose as much when interest rates go up. So that's the first part of risk management is keeping that duration. One of the other things we do on the risk management side is spend a lot of time on sizing. And sizing is very important. There's no such thing as a bad trade. There's only an incorrectly sized trade. And the way we kind of size the positions is there's two factors. There's your conviction of the trade. Are you highly convicted that you're correct? Or do you have modest conviction, right? And so there's always a range, and I wouldn't say it's mathematical, but you feel it in your gut whether you think you've found something interesting. And so that's the conviction part. And then there's the return profile. That's the second factor. So asymmetric to the upside is very different than asymmetric to the downside, right? So if we have a very high conviction position that we think is asymmetric to the upside, so very little downside but lots of upside, we might size that close to 5% of the portfolio. If we have lower conviction, okay, and it's an asymmetric to the downside trade, often like risk arbitrage, where you can make a little bit if you're right, but you can lose a lot if you're wrong. Those type of positions we would size closer to, say, 1%, right? And so if you can get the positions sized correctly and line it up with your conviction and the risk return profile, you can manage mistakes, right? You can, and so we've had mistakes in the portfolio. They happen. You don't want too many of them, but when you have them, you don't want them to be fatal. You want to lose 10, 20 basis points on a position, not 2% on an entire position. And so that's why we've had a decent return stream, is because I think we've sized positions correctly. When we manage risk, the best, when we're wrong on the event-driven side, right, we sell as quick as possible. And that's an important thing is you've had a thesis. If you're wrong, you need to turn around and you need to exit the position because you had a view of why you owned it, and that view's wrong. And so taking your lumps and moving on is a big part of risk management, and avoiding further losses, right? Especially in credit, because credit, again, at the very basic level, credit has limited upside typically, right? Bonds, you can get back par plus accrued, but it has unlimited downside. So credit is the opposite of stocks. Stocks have unlimited upside, right? Credit doesn't. So you have to be vigilant, and it's really common equity investing is picking winners. Credit investing is avoiding losers. It's the exact opposite mind frame. And so that's how we operate, is it's not the bonds you buy, it's the bonds you don't buy. And so avoiding things is the key to kind of outperforming in the credit area, in my opinion.
That's great. Well, that's all the time we have for today. I really appreciate, Adam, your time and your thoughts. The fund has obviously done quite well under your stewardship. So, myself, and because I own it too, but clients very, very happy with the performance of it. To everyone out there, if you do have any further questions about this chat, do reach out to myself, Jim, Angela, or Alex. And definitely, if there's any questions about anything else that Starrett Wealth Management does, we're here to help. So thanks again, Adam, and
thank you
hope you
very
have a
much.
great rest of your day.
Yeah, take care. Thanks very much.